Good morning, team. Welcome back and happy Monday. Welcome, Dan. Glad to have you here. I'm very excited about this session because last week was probably one of the craziest week we've seen for a very long time. And today we're gonna show how the power of data can help you navigate those difficult markets. A lot of people were very concerned last week, and of course they are still today. So we are trying to provide you with some context on how you can leverage some of the models. And today we're going to spend a lot of time on our swing trading model. The swing trading model is, I think, one of the most powerful that we have developed. It was released at the end of last year. And I think a lot of people are using it, but we want to really show you the power of it. And then we're going to spend the first half of the presentation on the swing model. And then, Dan, we're going to come back to you and look at maybe some potential earnings and how we can use the data for that. But welcome, Dan. Nice to have you. I think you're on mute.
We stuck the microphone. So, hello everyone. Happy to be back. Thank you, Fabio, for having me again. Very exciting showing today. I'm also can't wait to see take a peek into the future, and let's just start and then look at the other stuff if we find some time.
Yeah, absolutely. All right. So let's maybe a recap. Of course, everybody's aware, but this is kind of like the biggest headlines we had for last week. So clearly, a very, very volatile week, very, very driven by obviously news, macro events, tweets, all of that stuff, right? So this was probably one of the most volatile week we've seen probably over the past 4 or 5 years since COVID, I would say. So of course, the challenge here is that how can we navigate those days and how can we be prepared for something like that to happen, and how can we use data to potentially take an advantage? So what we saw last week is the SPX went down about 12% in a very, very sharp sell-off in a matter of a couple of days. And in one day, we saw a plus 10% in a single day, which we haven't really seen probably in our lifetime. The VIX, on the other hand, went all the way almost to 60. And then we saw a massive volatility crash during last week, the end of last week. So very, very big events, big volatility. And of course, how can we prepare for that? So the problem is that most traders are not used to this type of markets. This market is driven by a lot of variables. It's driven by news, of course, but it's also driven by option flow. It's driven by algorithms, and it's also driven by quantitative firms that are just really using NLP data and all the news that are happening. They're just triggering systematic trading system that are driving liquidity, right? This is happening more and more and faster than ever before. So obviously, as a retail trader, how can we survive this market and how can we be equipped with the tools? And the problem is that the reason why a lot of retail traders fail is because of these variables, right? So first, we are trading ideas, but we don't really have a system. So the market is not providing us an edge, and that's why we fail. We also mismanage risk in many of the times. So we are oversizing our winning position, but we are also taking a lot of unnecessary losses because we don't have a good risk management system in place. Then we have emotional trading, right? A lot of us are driven by emotion. We have our biases, right? So when the market was down 5%, we were thinking that that was the dip and we went long, when on the other side, the institutions were actually selling more. And then the next day, I think was the Friday before, we saw another 5% drop. So obviously, emotional trading basically it goes against the way like other institutional trading. They use data, they are data driven. Then of course we lack of adaptability, right? We are using a strategy that maybe has worked in the past, but again, the world changes very fast, and with AI, this is going to keep growing. So we need to focus on not on what should happen, but what is actually happening. So if the data is telling us that the market is very bearish, let's follow the data and let's look at how to work with the data. Then, of course, we most of the times over trading, right? We are more forcing ourselves on, I need to trade 5 hours a day to be profitable, rather than I only need one trade. And if I do a good trade, then I don't need to trade for the rest of the day. And then the other part is, of course, we don't document our data. So we don't really journal our execution. And therefore, we don't really know if when we are successful and how can we improve, right? So those are typically a lot of mistakes that we all do. But basically, today we're going to show you how we can help you and how we can support you in that process. So why data-driven trading wins, and why did we develop also MenthorQ? So the first thing is you're removing emotions, right? You're trading based on data and not on feelings. And of course, feelings sometimes can really be our biggest enemy. Then, of course, you can use data to improve your risk management, right? So you can have levels that can tell you your potential entry and exit point, and also your position sizing, right? When should you go bigger and when should you stay smaller, right? Looking at volatility, for example. And then, of course, the goal is to create a process that you can repeat and reuse with reliable results. And of course, this will allow you to then improve and increase your strategy and have a better system. So today we're going to go over our swing model backtesting. So we're going to show you how the swing model has performed last week. We're going to do that towards the end. I'm going to spend a few moments to go over what the swing model is, so stay tuned. But basically, this is the results. We covered about 894 stocks, and we had two strategies. One was a long short that had a 65% win rate, and then we're going to talk about our option strategy that had a 92% win rate. So we're going to show you how you can use the swing model and how we're going to go through the details, and we're going to look at, for example, some results, and all this data is available to you. So we're going to show you also where you can find this file, where you can find this data. So stay tuned on that, and please send us any question that you might have. So again, we mentioned that last week was a very volatile week, and we're going to talk about options. So this goes back to another session that we did with Dan a few weeks ago. When should we buy and when should we sell options? So volatility is really one of the main drivers that would tell us when is a good time to sell option and when is a good time to buy. So if volatility is high, this is really at the basic of option trading. We have more chances of success if we are selling options, because we can get more premium, and if volatility crashes, then we can benefit from that. If volatility is low, we have more chances of success by being option buyers, because volatility could increase and therefore our premium could go higher. And if we are selling options when the volatility is low, we risk that we could actually incur in losses because volatility could go higher. So we're going to talk about option strategies also by looking at the swing model backtesting. So what is the swing trading models and how can we use it? So the first idea of the swing trading model is to replicate what we did already successfully with our one-day expected move indicator. And we wanted to actually allow an accurate precision and an accurate forecast of where the price of an asset could be in 5 days and 20 days in the future, so 1 week and 1 month. By doing that, we can quantify risk and reward zones based on data. We can identify high conviction areas of support and resistance based on options data and not just really price action or past price action. And of course, we can adapt that to any market. So we can cover stocks, we can cover ETFs, we can cover indices, and of course, provide you with the data. The swing model is based on 3 components. We have our upper band, which basically would be the upper level of resistance that we see. And basically, it would come when we have a bearish bias. So the goal of the swing model is not only to give you areas of support and resistance, but also leverage the option data to provide you with a bias. Is the market bearish or bullish? And if that is the case, then how strong can that upper band or lower band hold, and how successful can we be? So whenever we have an upper band, we have a bearish bias. So we should be really, looking for a bearish setup. This is inverted. Apologies for the slide. When we have a lower band, our bias is bullish. So we should be looking for bullish setups. Apologies for the typo here. And then we also have our risk trigger. So the risk trigger would be the level on the opposite side. So if we have a lower band, the risk trigger will be above the lower band. And if we have the upper band, the risk trigger will be below the upper band. And the risk trigger is typically a volatility zone or an inflection point. The very important part is that we generate one key level per day. So on any given day, there's only going to be either an upper band or a lower band. And of course, you will always have a risk trigger. And basically, that is very key. So please let us know if you have any questions. So when we look at the bias on the left-hand side, we see the swing model as of yesterday on GLD, so on gold. We have a lower band. We also have a green price. So whenever we have a lower band, the model is bullish. And on the right side, you actually have the swing model, 5-day for XPX, and we see an upper band and obviously a red price on the right. So whenever we see the upper band, the model is bearish, right? Very, very simple. Then what we do provide, and we can go and look at how to read the data. So if we have a bullish bias and the price 5 days or 20 days from now close above the lower band, then the model is successful. So in this case, the model is showing us a 287.51 level. If in 5 days from now, the price of GLD closes above that level, that is a success for the model. So we're trying to predict the floor, looking at the lower band, and the resistance, looking at the upper band. If we see a bearish bias, so if we do have an upper band and the price in 5 days or 20 days from now close below the upper band, then again, the model is successful. And at the top right of the screen, you would see the success rate. So in this case, you can see the success rate of the risk trigger. That means that the price should close below the risk trigger in that case for the model to be successful in 5 days or 20 days from now. You see the success rate of the upper band, you see the success rate of the lower band, and then you see the total success of the model. So in any given time frame, we could have a period where we only have upper bands or a period where we only have lower bands. So the model provides you the overall success of that period. And we go back, in this case, 119 days. So on 119 days, which is over 4 months of data, the model was successful on 88.24% of the cases. So that's very important. Then we are also going to release this week the auto-updated indicator. So we already have the indicator available for you guys, but this, as of this week, similar to what we did with TradingView, we're going to introduce our indicator that will automatically update. So you'll be able to find it under your invite-only section. So stay tuned for that, but the data is already there. So the data is plotting basically the last 5 days of level. We're looking at the 5 days, and you'll be able to have those in your chart so you can use them as areas of confluence, support and resistance, and basically plan your swing trading accordingly. The best thing is really that what we believe our swing model is truly unique because it's really versatile and it can be used by different trading styles. So whether you're a day trader, a position trader, or an option seller, or even like a long-term investor, you can use the model to potentially predict where the price could be in 5 days or 20 days in the future. You could actually use the model for sentiment. So if you are a day trader, for example, you could look at our swing model to find critical points that could serve as intraday support and resistance levels. And these are not just arbitrary lines. They are data-driven inflection points that are derived from our option data and our machine learning model. So by knowing these levels, you can actually place maybe stop and targets, right? Reducing your risk and increasing your risk reward. So that's how, for example, as a day trader, you could potentially use the model. If you're a swing trader, then obviously we developed this model thinking about your workflow in our mind. And the 5 days and 20 days model really aligns with your time frames. So you're looking for maybe a 1 week or a month positioning. And again, you can get some really very important level that can help you understand where the price could be in 5 days or 20 days in the future. So that will allow you to potentially plan your workflow, and also look at data when you're building a plan. Then we also thought about option traders, right? So if you are an option seller, this could be a very, very important model that you can leverage. So one of the biggest challenge in selling premium is knowing where to place your strikes, right? So basically, our upper and lower band can provide you with ideal boundaries for credit spreads, iron condors, and other strategies that are related to premium selling. So very, very important. And once we go back with Dan, we're going to look at that. So basically, really is giving you an idea of where your strike should be. Similar to what you do with our zero DTEs data, you could use this data to potentially plan your strikes accordingly. And finally, if you are simply a long-term investor, so if you are really investing and you're not day trading or swing trading, but you're really taking position on an asset, whether it's a stock or an ETF, our larger model, our 20 days, can really help you understand price levels, understand where the risk can be, also understand when things change, right? So when we see like the model changing from bullish to bearish, then maybe if you have a big position there, you could use that data to potentially protect yourself, maybe like buying some puts or maybe like adjusting your risk manager. So basically, the key part is that really this model can be used by really any type of trader that are looking to find direction of the asset in the market. So let me just go back and let me know, Dan, if you have any feedback there.
Basically, I'm amazed. This is something I've been hoping for. And yeah, basically, guys, just be ready to use it, whatever you do, because I think, and Fabio said something very important, especially in this last slice. We might be some kind of traders, but we all do have certain flavors in our trading, and I would see myself in all of these. So for long-term portfolios, you can set up your hedging, and even if you have a long-term position and you set up a hedge, you will gain. Basically, you will make two ways. Money, because on the long term, you will make money because you've chose something which should rise, if you're right about the long term, plus on the short term. And even on the short term, if you swing, you can use the levels to profit. So I see four ways of profiting, which is like, this is the thing which we want to do. Even if we believe in efficiency of markets, in short term, the efficiency is annihilated. So this is basically a tool where you can really, really use it. And I said it to Fabio before we started. If you have been using the automated levels plus the plotting and everything, it works like charm. So for the day trading and everything with a gamma level. So now you got another tool which is specialized for all these things, where you can basically set up a trade, where you can select your strike properly, you can do your risk management and all the things we talked about last time. Yes, it wraps it all up. So you gotta set up. You should be super, super happy today.
Yeah. And now I think, Dan, we can go into the backtesting results and we can explain
Yes.
what we did. And then we can, let's see if you guys have any comment. All right, so first of all, to look for our swing model, you can come to our dashboard and you can find our swing model here. So we have our 5 days and our 20 days. So in this case, we're looking at NVIDIA. The model is currently showing us our lower bands. So we are kind of in a bullish bias from the model. So the idea here is that our support level is 101.53 and our risk trigger level is 120.33. So if in 5 days from now, NVIDIA closes above 101.53, then we will see our model being successful. So if we look at the past 119 days, the swing model success rate was 81.51%. So as you can see, what you see here is really the price on that day and what the levels was that was a given. This would have been given to you 5 days prior. So you would have known this level 5 days before the price closed here, and that's the same basically applies to all the others. We can do the same for our swing 20 days. So again, the success rate was 91.35 on the past 104 days. And as you can see, we had the majority of the time we had our lower band, but we also had some days where the market turns negative and the model turns bearish, where we had our upper band right here, right? So right now, in the next 20 days, the model on NVIDIA is forecasting NVIDIA price to be above 92.12, right? Again, this is data, is not recommendation, is really like what the data is telling us. So now let's go into our backtesting. So we're going to show you the data on a file, but we also provided all this data and all this analysis on our blog. So if you go and you have an account with us and you go through our guides, simply come to the section here under Quant Strategy, click on Swing Level, and then you will find the data that we're going to show you today. We also have other backtesting that we did a couple of months ago. We also did others like in October during the earnings, so we're going to talk about that as well. But essentially, let's go through the assumption, right? So let's go in the file. So the assumption was very, very simple. We take the data as of Friday. So we took the levels that were published after the close of Friday. 4th of April, 2025. And basically what we do is we take all our coverage. So we have 894 stocks here in the file. So we apply no filter, no market cap. We just want to show you how the data performs on a very large basket of companies. So then we take the risk trigger and the level. So we have our upper band, our lower band, and we have our value here. And then, of course, if we have an upper band, then the bias of the model is bearish. If we have a lower band, then the bias of the model is bullish. So this is the data that we got at the end of the day after the close of Friday, April 4th, right? Then what we do, we did this over the weekend, and we simply have two very simple strategies. One is a long short strategy. So we are buying the actually underlying. So we're buying the stock based on the bias of the model. So we go long if the bias is bullish, and we go short if the bias is bearish. This is a simple long short strategy. We trade at the opening price and we close at the closing price of the Friday. So Monday to Friday, trade at the open, exit the position at the close. The reason why we do this is because of simplicity. We take the open price from the Monday and we take the closing price from the Friday. There's no risk management applied here, so there's no stop loss, take profits. It's a very, very simple backtest, but the goal is really to show you how the data can help you, right? The second strategy is our option selling strategy, right? So we sell credit spreads based on the model and the bias. So the idea is that if the model is bearish, then we would sell a call credit spread, and we want to sell above the upper band level. So we want to find a premium above this level. So we don't want to just sell an at-the-money credit spread. We want to look at the upper band and our lower band. So if the model is bullish, in this case, we would sell a put spread below the lower band. So we will look at this value and we would say, okay, like if there is premium below that, we would do a credit spread. Because of simplicity, what the assumption is we look at the close price, and we want to see that the close price at the end of the Friday is either above our lower band or below our upper band. So if we are bearish, we want the price to be lower, and if we are bullish, we want the price to be higher. And then we would call this a success, because of course, if we're selling a call spread and the price at the close is below this level, then the option expire worthless. So we are pocketing the full premium. On the other hand, if we sell a put spread and we sell below this level, and as of Friday, the price is above that level, our put spread would expire worthless, and therefore we pocket 100% of premium, right? Very, very simple. Let us know if you have any question. Let's see if we have any comment. And so essentially, let's go through the results. We're also going to look at our Max 7, and then we're going to talk about risk and diversification, because that's going to be a very key topic. So if we sold or bought all of these assets, all of these 894, our win rate was about 64.77%, so 65%. So here what we calculate is really, if we are bearish, we would sell, and we calculate the return right here. So in this case, our close price was above our opening price. So we had a negative return, minus 0.08%. And we had, this is the P&L in real money. So we assume that we trade 894 companies, $1,000 per asset, so that we have an equal risk on all the different assets. And then we calculate our P&L at the end of the week. So we had a win rate of almost 65%. We had a returning percentage for the week of 3.78%, and we had $33,788 in profit. And again, this is simply going long short on one of the most volatile week following the swing model bias. So very, very important, because of course we are looking at a large amount of companies, large number of companies. But then let's look at the option strategy. And with the option strategy, this is even better, because we can actually have more flexibility. So with options, first, we were in a very volatile week, so our premium would have been very high. And then, of course, if we can have support from the data, then we can also potentially maximize our wins and minimize our risk. So with the option strategies, we know that a call credit spread has a limited risk, as well as a put credit spread. So our win rate with our option strategy would have been 92%. That means that 92% of these assets that we calculated ended up either above the lower band or below the upper band, and therefore our credit spread strategy would have been successful. Let me know that, Dan, if you want to ask any question. And there's a question about the spreadsheet. Yes, the spreadsheet is available here. So if you go through our blog, you can download the spreadsheet right here. So everything is available for you guys. So just click on the link. The same spreadsheet that I'm showing you would be available there. And to get there, just if you have an account, just go under our guides. So if you go back to the dashboard, click on guides, and then click on under quant strategies, swing level, and then here, this is the latest document. You can also see it there. And then, of course, the spreadsheet is available here.
Oh, I think we answered some of the questions there, guys. I have no questions, because I'm just amazed, and basically it's something which makes it really, really easy to use. And the nice thing is, and that's why we're doing this these sessions about options, and we work ourselves slowly from the basics to more complex stuff. On the long run, we take other things like earnings and other aspects into consideration. But you got a strategy which is very simple, like a weekly strategy, especially if the market is a bit unhinged, how it is right now. You can just trade on a weekly basis, and you don't have the whole risk. And why I like these results, because it shows again, if you take the time to mingle with options, don't get wiped out, follow some basic rules, and use the data in the right way. You see, you can have an awesome, astonishing win rate, and you shouldn't put all your money right away in. Take out a chunk, think how much you want to invest. Like Fabio said, it's all about risk management too. Both the most liquid stocks, and we will talk about how we can trade these things, what I would do with all these stocks. And maybe the win rate is a bit different. Huh? You have the spreadsheet, play around a bit, depends how much money you want to put at it. But if you're new to it, trade the Max 7. Why? Because the slippage is the smallest. Are they hit together? Yes. So if you feel like you need to diversify, look at the biggest ETF, divided by the sectors, and take one stock, the most liquid stock from each sector, and build yourself your small own portfolio with options for a week. And you can all retrace that here by using the spreadsheet. So this would be something, if I had some time on the weekend, I would take this and say, do I want to trade the stocks just long and short. Do I want to trade with options? Do I want to trade with options? Do I want to trade all the stocks? Which stocks would I trade and retrace it? And if you feel unsure, reach out, ask us questions, or in the end, try out, dip your feet in, and build yourself a small portfolio. If you feel like better with 20 days, trade the 20 days. So just use what you have here to adjust basically the data to your trading style. This is just an idea we give you, but in the end, if you learn to basically trade with options, you can do anything. We're just talking here about very basic spreads. But basic things are not bad. Basic things, if they work, rinse and rise and repeat. And if you can do that on the long run without getting wiped out, especially in a week like that, there's nothing to fear.
Yeah, and I think, Dan, the most important part is you mentioned Max 7, right? So we do have, we extracted the data from the Max 7 as well because we wanted to be very transparent. And of course, the result, just on looking at the Max 7, so first of all, the long short would have not worked because we had only a win rate of 14%. And our option strategy, I don't know why it's not appearing here, but the win rate was about 55% or 53%. So overall, the problem last week was that, of course, the market was heavily affected, and the Max 7 were really heavily targeted because of the news. So of course, if the market, if 7 companies in the same sector are heavily correlated, then you will see that, of course, there's going to be maybe some issues. But overall, like the key there is really diversification, because you don't want to put your eggs in one basket, because if one basket is really going down, then of course you want to diversify. So what this data is showing you is that even looking at the universe of about almost 1,000 companies, you can actually get really interesting results using the data.
Yeah, and we had some other questions here. Basically, we had questions about margin and how much you need to follow the strategy. Well, this depends on how much you want to put in. It depends. Like if a spread, let's say if you have $1 wide spread, and then basically your margin is $1 you need for that. Simple as that. And the question is, how big do you want to trade? I always advise 1 to 2%, especially in the beginning for each trade, if you really want to set that up. And if you're really new to that, you can even put less into that. So if you're talking about trading with a margin account, a good thing to start, especially in this kind of situations, is never max more than 50% of your margin. Why is that? Because the market can change rapidly, even if you are in spreads, and if you're not aware of changes, if you're not used to risk management techniques, then even risking 50%, even with spreads where you have your safety and security set in, you can lose majorly, even if the model is good, because the model may be good, might give you good levels, but there are 2 things to consider. How good is your entry? That's one thing. How big is the slippage on what you trade? Like I see people trading stocks which do not have good liquidity because they think it will go up, it will down. Premiums are very high. Let's sell some premium here. Yes, we're gonna buy some protection there. Still, if you have a slippage of 20-30%, this is really hard to win. And that's one of the things. So dip your feet in, trade these things basically to your discretion with what you want to use, like 1 or 2% of your buying power, and maybe start with 5, 10, 20 and work your way up. That's the thing. And don't put all your eggs into one basket. And there was another question, why the strategy and the results weren't done with simple long calls or puts, for various reasons. I don't know, Fabio might want to answer that, but basically, you can take the simple long and the simple call, basically, and apply to the long and short strategy. You could do that. So the problem is you don't. If you go long and short with a debit, you have like we talked about 2 weeks ago, you have theta working against you. So the whole week, the clock is ticking that you need to reach something. If you talk about the swing model, which shows you levels, two levels which are out of the money, and basically the level which you are shown is not a level which is an aim. The risk trigger especially is not an aim. We take a look at the lower and upper band. This is a level which will act most probably as a support, or basically we want the price to stay above or below that level. So it makes sense to sell credit here, to have, if possible, like Vega volatility on your side. So it's not that low, so you get some good money for the risk you're taking. Plus, you want to have time on your side and to have a break even close to that. So all these screams, this is basically good for trading basically a credit spread. If you want to trade long, then basically the data should give you some guidance. But I don't know, you can do that if you expect, basically, if you want to trade a long call and a long put and want to go to the moon, this will only happen if really, really crass events happen. Did they happen? Yes, they did. Did you know about that? No, most probably not. I knew some, I was looking at the data. What did I do? I took some interesting trades. I did some hedging. Besides that, I was flat. Was I losing? No, I wasn't losing. I have hedged my long portfolio properly. I hedged some other stuff I had. Did I care that these things went down? No, I didn't care because I was out of time. Plus, I was making money on the hedges. When did I do that? 2 days before we had this nice liberation day. Why did I do that? Because I was able to read the data. But even with that, without knowing all that stuff, if you just had traded, having theta on your side, which is important, having volatility on your side, there are two factors. Even if you have crash moves, still you might be able to survive a rebound. I have a trade there which I put on, although I knew there's a risk, just especially for people to look at, which is a trade on oil, XOP, XOP, and I have a trade on XBI, which is the biotechnology. It's a short strangle. Take a look. It was down majorly. Did I do anything? No, because I saw the data. I see how the levels are shifting. Plus, do I need to hedge that? Yes, I did hedge that a bit, but that's not a problem. I know how the level works. So, and that's a short strangle in this kind of market, but I know what I'm doing there.
Yeah.
Will
I
this
think,
wipe me out? No, because it's 2%. And this is what I want to sink in.
and I think, Dan, we always have to look at probability of success, right? So why this
Yes.
slide is very important, right? Because if you went into the market on Monday and you said, "Oh, I want to go long a call, long a put because I think the market is going to move," well, in reality, you're not accounting the fact that volatility was already very high. So the VIX was over 50, was at 50 something, and went all the way to 60. So if you are like buying and going long, whether it's a long put or a long spread, you are basically paying a very high premium, right? And what happens if volatility crashes, even if the direction of your trade is correct, so even if the price of the underlying goes up, you could actually lose because of volatility and theta. So of course, why selling option is not better, but it's basically more advantageous, is because you are betting on not only the crash of volatility, but you're betting on the passage of time. And if that doesn't happen, that happens, and if the levels hold, then you're basically at the end of the week, your option expire worthless. So your return can be high because of that. So you're basically betting on volatility, crash, and theta effect.
Yes, and even if you want to go with a debit and a naked debit, then give yourself some time. Don't do it within a week. Like I had this question some time back. I want to do a debit, naked debit, long call, long put, without there being any significant news on something or something in the data. And I said, don't do it because you have 3 days. The
Yeah.
water will rise faster than you can
Yeah.
look. So do I do debits? Yes, I do debits, but I give myself time and I have volatility on my side, because volatility in these kind of situations might be so low, that even from the spike of the volatility will go up. because if the water rises, all the ships rise. That's a thing, and that's the reverse. With the volatility is too high, we expect it to go down. Can it go higher? Yes, it can. But that's why we should give ourselves time on our trades. I hope this answers the questions. If not, guys, just shoot out, and we will try to answer your questions more thoroughly.
Yeah. Yeah, let us know, guys, and everything can be found here. So if you have any doubt, just come to the blog. We have all the data here. We also have the past results. So we have our February, we had October, we had earnings last year. So we had really a lot of data available for you there.
Okay, maybe Fabio, one thing we can go back, so we can talk about risk management and things. Let's go back, and because we're here, we have people here listening and they're interested. So you looked at the Mag 7, so maybe we can go back, see what kind of level we chose on the 4th, and how the swing levels, which will be available, let's say we go for a 5-day trade, and we don't know, a volatile week is coming, but let's go back and let's see which levels we would have chosen for a break-even point, and let's see how the swing levels, which will be available for an indicator. I'm not talking about the gamma levels. This is something different. But the swing levels, how they could have helped us, and I haven't prepared that, but we can check these levels later, how these levels could have helped us stay calm in the week, maybe scale up, scale down, scale out in time. So let's take a look. This is just a dive into the blind, but these are the nice things we can do. This is what we do every day when we check our trades. All right.
All right.
Okay, it's coming. There we are.
So
Wonderful.
this would mean the levels that you would have got as of Friday, Friday the 4th, available for you at the end of the day. And then here we have our Monday. So yeah, so we have our risk trigger right here. So as we can see, this really acted as a support. So this was the data from April 3rd. So it was the risk trigger from a few days prior. So this really was a very, very important support area right there. And then we have our upper band right here. So again, this was another important kind of like area where the price tried to move up and then came all the way back down again. Then of course we had the news, and then, but as you can see, you know, the March 31st level kind of hold it. So even if you had sold credit spread by looking at this level a few days prior to this, you would have seen that this level kind of held very well on the move, and then the price came all the way down.
So let's make it simple. Let's say we entered this credit spread here down where we thought it would be, and we have this lower level, and we saw on Monday, which was a level from Friday. So let's say we chose our break-even point there. So there are 3 things we talked about. So you need to have a plan. So this plan should have various things in it. So what do I do if I reach a certain price level for taking profit? So if you feel comfortable ending this trade, although you still have 3 days and time is working for you, where would you put your price target? The first price target is where Fabio showed the upper level, where it went down. But we saw that it went up there, and we saw that it was circling down there. So if we go back, Fabio, to let's say we set up on Monday, and we go back to Tuesday. So you're 1 day in. So from 94, we go up to 103. Is your trade in a winning position? Yes. When the market opens, yes. And then you see the dip. And the moment you see that it goes through that level, you still have time. You can still close for 25% maybe, which is legitimate. You can close a trade like 25% in 1 day. Some people want to make 200%, yes, but 25%. repeatedly over and over. It's like exponential growth. You should always understand with trading, it's about rinse and repeat and exponential growth. Exponential growth is like wonder of mathematics. So
Yeah,
that
and
would be maybe, yes.
the other thing is really limiting the time you be on the trade. Like you mentioned, if
Mhm.
you can get that 20% in less than a day or in one day, then yeah, that's much better than risking the price or a catalyst event to potentially have an effect on your trade. So
Well, let's say something else happens. You are a trader which want to swing, really want to swing. You want to take it relaxed. You don't want to mingle too much. So you just want to manage your risk. So you say, basically, my plan is to hold this trade through the week. I might close if we really did below my level. So let's say you slept in on Tuesday and you saw the trade is up 20%. You feel good about yourself. You feel right. You did something right. And we're dipping. And we're dipping. Are you okay? Are you confident? Yes, you are, because you have a proper level there where it bounced off again. So in the end, you come back to your break-even point. Are you are you in- are you in the are you losing? No, you're not. Why? Because you already have 2 days. In the end of the day, you have 2 days of theta working for you. So already this trade might not have been in 20%, but let's say 5%. Look, 5%, it's okay. Pays the fees. You
yeah,
stay relaxed. So if you had stayed there, you still have your price target, and you say, my price target is, let's say you had 3 contracts, which is a nice thing. First contract you take off on Tuesday. You have two left. They dip, they go to 5% only, but still in green, and they go up. Will you take them off? I would have taken off the next one on the 10th when we really went up there, or on the end of the 10th, on the 9th in the evening, because the upper band from the 31st of March is hit. Wow, that's one which must have been up 50% or 65%. I'm just guessing, but this is roughly the thing. I would have taken that off. If you're confident, leave a runner, because now you have 2 levels. You have the lower band and the upper band, which are in the middle, which right now is support. We broke through that. Plus, you have the really low levels from last Friday. So that's the thing. You can leave a runner. So this is house money. So this is a good thing. Or you manage the third contract again there and take it off. So that's the thing. This is the way you scale into things, and you create your own roadmap with that thing. So the first thing is you find the levels you like, you see the setup, which is simple. You don't need to look at other stuff. You can check again the gamma levels. Yes, this is helpful. You might double check that. I wrote something about how these levels are, they plot. They plot automatically. Fabio explained it to me, thankfully, and I watched the video he did with Patrick. But the thing is, before you do, and I think I put it into MenthorQ, have a plan. Don't act emotionally. You like NVIDIA, you want to trade, yes, but for discipline reasons and for journaling, sit down and say, I want to sell 1, 2, or 3 contracts. What are my aims? Where I'm going to exit? How will I do that? Is my aim just to go worthless? Is my aim to take profits early? And if you are fast in profits, take some money off. Take some money off, because we don't need to make 100% every time. Because I've seen so many trades in the last days. If you keep all these 3 contracts and we had a dive in the end, you might have been in a losing trade. But if you've taken off 2 trades with 25% and 65%, the rest is house money. So this is the way I would do it, and these levels will make it even easier for you. So you see how all this data comes together to create you a very easy, basically, trading environment. And this in a week, which was like super crazy, it was like watching some telly and
yeah,
historic times.
like what
Historic times. So,
for sure.
so this is a week where you could have made money and told your grandkids about.
Yeah,
I survived Liberation Day and I made money. You don't need to mention how you did it, but if you did it, that's the thing. That's the important thing. No one asks. No one asks the winner. Simple as that.
Yeah, and the other, I think the theme of the next few weeks is going to be managing risk. So the key
Yeah,
is, okay, don't think about, oh, I wanna, there's going to be volatility, I want to make money. The really important part is, how can I go through this turmoil period and still make money managing my risk? So if you sell a spread and you make 20% in one day, you did great. You don't need to make 100% to be successful. And also you need to think about risk management first, because things could happen really fast, and that can leave you behind. So that's the whole point of all these levels, all this data, to provide you with the tools that can help you manage that risk.
exactly, because you take more risk on. If you just invest in the spiders, you make 8 to 12% a year. You make 20% in a day, cut off some fees and slippage and everything. Let's say you end up with roughly 15%. Is this good? Is this awesome? Yes, you see some traders, especially in futures and other stuff, they make a lot of money. Legitimate, really, really good. And I know a lot of option traders make a lot of money. Legitimate. Do you know how big their portfolios? If someone makes like 10K a day, but his portfolio is 10 million, it's not that much. You know what I mean? So you should always, and this really takes time to sink in. That's why it's important, because before you just, especially when things are easy, like this is the only danger. And if things are as easy as they are with MenthorQ, don't get overconfident. Just take a step back and be grateful to have this great data and these great setups, and sit down and write it on a paper or somewhere else. I provided you with an Excel, I think, or with a PDF or something. I can repost that, and sit down and take 2 minutes to write down what is your aim, what do you want to do. And yes, there are black swan events and other stuff, but take the data and just choose levels where you want to get out. And if you have questions, take a screenshot of what we showed you, put it into AI, for example. I know people who do that and say, please create me a roadmap. And it will do that because it got all the data it needed.
Yep.
If you feel uncomfortable and if you have questions, tag Paul or me. We do this options trading for a long time, so we can really help you if you have questions there.
Yep.
So yeah, that's a nice theme for the weeks. Yeah. Sorry,
Yeah,
Fabio.
let us know, guys, if you have more questions. And I think for this week, what's going to be very important is looking at VIX expiration and OPEX. So we're going to have some big option expirations. So we're going to talk about it on Wednesday. But I think it's going to be an interesting theme that we can maybe look over it on Thursday or Friday. Also, we're going to be live with Ryan, so we can discuss that. But looking at that type of insights, and also looking at the data that we provide, would be very important.
Yeah, I think we don't have that much time to look over earnings.
Yeah, we can do that next Monday, maybe.
We can do that next Monday, just for your discretion. We have some earnings, bigger, smaller. We have a couple of banks. We have J&J, Netflix, ESM. So I just want to point you to two things here in the last 2-3 minutes. Use the data as we showed you to trade either directional trades, let's say for Netflix, but especially for Netflix, this is something like I took a look at the data, and this is something you can get from any AI or just going through your broker and looking up the data. For example, Netflix had a nice, let me look at my data. They moved roughly 15% last time. Average move is last 10 years is roughly 12.5%, in the implied move. The move, which is expected, is 10. So the thing is that the market expects the move to be lower than the average move, but normally we see that the average move has some say in it. And if I have remember the data correct, the 5-day swing model is at 850. Let me take a look.
Yeah,
850. So sit down to calculate. I'm giving you something. I'm giving you some help here. If you set up a trade, maybe we can do that in the last minutes, just because we were talking about risk management. 850. Oh, let me share my screen 1 second. So this is something maybe we can just do something nice here. Where are we? Okay, 850. So you see, this is the $5 wide spread, and you just get 50 credit. And we have an implied move of 10. So if the market is right, we're going to stay there. Is this a trade? Like, I don't know, the model will move in the next couple of days, so keep an eye on that. But this is a trade which most probably the model will be successful because all my data has a bit of a bullish bias, but this doesn't mean anything. If the market is not happy with what Netflix tells us, the algos will dump it. So this is here a trade: lose one, basically make one to lose and lose 9. This is a bit tough trade, but let's say you want to take it. Let's say you want to take it. So I told you that the average move is a bit higher than this one. So maybe this is another factor to rethink that here. So maybe there are other trades which are good or have better statistics, and the model is more confident because it gives us a risk of 1 to 3, max 1 to 5. What I do, but this is something you shouldn't do if you're not experienced with that. If I have a strong bias on something, I might go and lean to one direction because I know if I win, let's say, with a model like we showed you on the earnings, let's say 7 out of 10 trades, and I have set up, let's say, broken wing butterflies there, which are really nice, giving me some nice credit. You could normally do them for a debit, but if you set them up right for a credit, I will still be in the winning. But this is something you need to know how to hedge that, to manage that, and to do that. We will do that in some advanced course. So these are things you should, if you use the model for earnings, please keep that in mind. We're in volatile times, and risk before reward. This is basically why I showed you that, because I like trading Netflix, and let's see, maybe we will set up a debit here or something, and just for purpose of showing how these things can work, and we can talk in a further session about that, so we have something to think and ponder about. But please remember, risk comes before reward. Sit down, write the things down, and be ready to take a risk, because anything can happen. If you're not ready mentally, you will do mistakes when you are challenged. That's the thing. This is something we have to learn. Even the best data can't help you there.
Yeah. Yeah, and there's no model that can for 100% predict the outcome. So
No.
it just doesn't exist, unfortunately. So we're working on a probability game, and of course we want to be on the trades that give us the best probability of success.
That's the thing. So I'm really excited looking towards these things, and I don't know if anyone has done Monte Carlos and other things. This is really nice stuff, but on the long run, we're going to talk how you can take other and longer trades with them with probability, and when the model of MenthorQ is ready, we will help you even with more, let's say, stressful or more challenging setups, and how you can choose the best ones according to the data.
Yeah.
So thanks for listening in. Thanks, Fabio, for having me.
Yeah.
Great stuff today.
Any question, guys, send us an email, info@mentorq.com. And thank you, Dan, and I look forward to have you next time.
Yes, see you next week, guys, and happy Easter to everyone.